Despite the Eurozone crisis, the German economy continues to grow. German Consumer Price Index was announced on Wednesday morning and it increased in July, rising by 2.4% on a year-ago basis. The EU harmonised rate also rose 2.6% from a year ago. The inflation rate in the country is closely watched by the European Central Bank, and rising inflation could put pressure on the ECB to raise rates again this year. Joining me on the line to discuss German CPI and the impact it has is Dr. Schulz. He's Senior Economist for Berenberg Bank and he's also worked for the ECB. Thanks for joining me, Christian. Do you think inflation will continue to rise in Germany, and what are the main reasons for the rise we have seen?
German inflation has risen and it's still on a slight upward trend. The main reasons seem to still be oil prices, so sort of delayed effects via energy prices still drive the German inflation rate. Core inflation is still quite a lot lower than the headline inflation rate, so it's still energy prices. On top of that, of course, the German economic environment is more benign for higher inflation than in the rest of the Eurozone. So if you compare to the rest of the Eurozone, where inflation has been falling quite steeply in July, then you can see that the booming economy in Germany has a tiny bit of upward pressure on inflation.
The ECB watched the inflation rate in Germany quite closely. Why is German inflation so key to them? And do you expect the ECB to raise their rates if inflation continues to rise in Germany?
German inflation has always been sort of a lower anchor for European inflation. It has traditionally been quite significantly below the average European inflation. So if the lower anchor is moving up and actually converging with the rest, and in fact in July inflation rate in Germany, the harmonized one was higher than the Eurozone average, then that of course changes a bit the structure of inflation within the Eurozone. However, the European Central Bank is unlikely, in our view, to raise interest rates again this year. We've changed our call on that because of the weaker economic environment and the weaker data that will be coming in as the ECB progresses. So the first opportunities for them to raise interest rates would be in October, but by then data leading indicators should be weak enough for the Governing Council to appreciate that and to stop with its rate hike cycle for the time being.
You mentioned weak data there. Although the German economy has been continuing to grow, exports fell in June and there are signs consumer and business confidence could be waning. Do you think the German economy is heading for a slowdown, and would that put a stop to any further inflation rises?
It's true that some of the recent German data has been slightly weaker than expected, or slightly weaker than in previous months. However, one of the key data points was really the industrial orders, which came in last week, which showed that for a third month in a row, orders rose significantly. And that means even though, of course, the global environment and the European environment, so the export markets of Germany are weakening, and that's going to progress, that weakening, the German companies still have a huge cushion of orders, export orders and domestic orders to work on. So any further slowdown in the German economy that we will witness will be cushioned by the huge pile of orders that these companies have built. Inventories are extremely low in Germany, so there's a lot to cushion any downturn in the global economy and its effects on Germany.
Finally, the German government are resisting calls to enlarge the Eurozone bailout fund. What is the main impact on the German economy of the crisis and the EFSF debate?
Well, there are two effects, and they are going in opposing directions. One is a bit ironic. Germany is obviously benefiting from its currency not appreciating as much as it otherwise would. So if you compare Germany and Switzerland, they have about the same industrial structure, export dependence, and also level of indebtedness and so on. Switzerland has a currency which is now stifling its exports, whereas Germany, with the euro, is happily exporting along. So that's a positive, bit ironic positive effect for Germany. The negative effect, of course, is on confidence. Any bailout so far has had negative consequences on confidence, consumer confidence and business confidence in Germany. And confidence is really what's driving the short-term cycle. And that, of course, affects the German economy as much as the export markets in Europe, which are, of course, weaker due to all the austerity measures that are being implemented in these southern European countries.
Thanks very much for that, Christian. There is plenty more to keep you updated on the Eurozone crisis and other issues that might move currency markets online at Dukascopy TV. Goodbye.